Insurance has never been a topic that people like reading about or listening to. It's not fun, it's not attractive, and some people are very apprehensive about it. But what if I told you that the very elite buy all kinds of insurance and that they use it as a strategy rather than a product? My name is Emmelis, Keaney, and whether you're successful or you're just starting out in your career, if you agree with me that without an income, your life would change dramatically, stay here with me for tips and ideas. Because in this video, I'm going to give you 7 reasons why the rich buy insurance. Throughout my career, I've met my fair share of people that said, the rich don't need insurance and neither do I. And it's usually people that are focused on the cost or the bill, or they see it as a hefty expense. But wealthy and savvy individuals, they see insurance as a tool that helps them preserve their wealth, take advantage of tax codes, and even increase their already huge nest eggs to beyond imaginable levels. And if you're not sure why the rich would buy insurance, I'm going to give you some reasons of why they do. When you walk into a room, you can usually tell the elite and wealthy individuals from the rest of the crowd. You've probably seen it in movies, ads, and charity events that high net worth individuals typically dress, walk, and talk different from everyone else. And even when they try to go unnoticed, you know when you're in front of an affluent person. From their zip code to zip codes in plural, from that heavy metal credit card that they use to pay for services and goods, and even the sizable donations they make to good causes. You know when you're in front of the 1% club. Ever been to a wealthy folks' house? Chances are they have a decent quantity of collectible items, from cars to art, wine and jewelry, you name it, they have it. Which is why we have collections insurance as the reason number 7 why the rich buy insurance. No idea what I mean? Think of the crown jewels of the United Kingdom. Originally called the Crown Jewels of England, it's a collection of 142 royal objects kept in the Tower of London that belong to British kings and queens, representing 100 years of monarchy. They're worth an estimated $3.5 to $6 billion US dollars. Included in the collection are coronation regalia dating back to 1661, fancy robes, and the highlight are the world's most exceptional collection of diamonds. And not just that, it includes the world's largest top quality white cut diamond. And yes, they're insured. Yeah, wealthy folks value and consider it worth a premium, ensuring that if there's damage to these items, or if any of them go missing all of a sudden, they can claim a monetary value for the loss or damage. And while you may consider some things priceless, some people are willing to pay a few dollars a year to compensate if the item or items become a memory. Besides, can you think of anything better than cash to replace something lost? If you watched the movie All the Money in the World, you learned about the 1973 Getty kidnapping case, when the 16-year-old Paul Getty III was taken for a $17 million ransom, and kidnappers expected to receive the green paper from his grandfather, billionaire Paul Getty I, who, by the way, refused from day one to pay up. Now, I don't plan on spoiling the movie for you if you haven't watched it yet, but I will reference a scene between Getty, played by Chris Plummer, and a former CIA agent, played by Mark Wahlberg. Paul Getty Sr., the billionaire grandfather, makes the remark that he has no money to spare, and the agent asked him what would it take for him to feel secure, to which he responded, more, as in more money. Which is why, in this list, we included Kidnap, Ransom, and Extortion coverage at number 6. Chances are, if they are in one of Forbes' list of richest people in the world, everyone knows that them and their family are worth a nice chunk of change. And crazy people may get the wrong, evil idea that they can steal it. The elite know that they are a target, and that at any time, someone can try to take advantage of that. In a way, these people become celebrities to master thieves, and many of them will insure themselves and their family members against the world's most daring criminal minds. That way, if one of them gets abducted, the family doesn't have to cough up their own money to pay for the ransom. At least not all of it, because this type of insurance would pay for it. Number 5, liability insurance. I'm sure you've used the expression, we're all human, we're not perfect. Well, if you make a mistake, don't worry too much about getting sued because you can buy insurance for that. And there's all sorts of kinds of liability insurance, but to name a few, I'll start with Directors and Officers Liability Insurance, or D&O. The affluent usually join or serve as board of directors for charitable organizations as well as for-profit enterprises, where they put their talents, skill, and knowledge to benefit certain organizations. In the process, some decisions can go really wrong, and people can sue the board of directors. Therefore, this type of insurance is designed to reimburse or indemnify the board member for personal losses or even legal expenses in association with their service to the board. Other forms of liability insurance protect them at the personal level, such as insuring for damages to domestic employees or protecting from lawsuits from guests that visit one of their many properties and they get, bit by a dog, or they fall and injure themselves, or even pool accidents. The most common people know about is umbrella policies, and they're usually attached to your homeowners or car insurance. And trust me, when you've worked so hard to afford the things that the rich can buy, you don't want anyone threatening your ability to continue to buy them. Because chances are, if someone's suing you for damages and they know you have money, they're coming for you, and they're coming for a large monetary portion of you. Which brings me to number 4. The affluent would not be able to build wealth if it wasn't for a high income. It all starts with cash flow. Unless you inherit massive amounts of money, chances are you'll need a high income to build wealth throughout your lifetime and be considered rich. When you graduate school and you get a job or start your company and you begin to collect a high paycheck or one that continues to increase, the last thing you want is to get sick or injured to the point you can't work, whether it's for a short period of time or for the long term. And what happens when you can't work? Well, you don't get paid either. One main thing that differentiates the elite from the average is that they set long-term goals and plan for things that can go wrong. And they recognize that in the process, things may happen that they cannot control, like an illness or injury. Although they usually have great health insurance, long-term disability income insurance will help complement that. A lot of them, especially the ones that work for larger corporations, also have disability insurance through work. But as I explained in other videos, this coverage usually has limits including how much and for how long they pay benefits. Not to mention, generally speaking, when a company pays for the policy from their pockets, if you have to claim benefits, then those dollars you receive are taxable at ordinary income tax brackets. Now, I am not an accountant, and you should definitely consult with a tax advisor before making a financial decision. But in essence, what I'm trying to say here is the wealthy don't like paying taxes. Well, in all fairness, I think we all despise paying taxes. So if they can get their hands on tax-free money, well, they will. And it is why they believe in income replacement insurance, because they'll be able to maintain their lifestyle and even accumulate more wealth, even if they can't do their natural jobs. Number 3, charitable giving. I mentioned charities earlier when we talked about liability insurance for nonprofit board of directors. Many wealthy individuals also believe in insurance as a means of making an impact in the world. Instead of dividing their lifelong accumulated wealth between their families and meaningful causes, many will choose to buy a life insurance policy instead to pay out to a charity or to replace a portion of the wealth left to a charity. The wealthy like giving back and supporting good causes. Many of them believe that as accomplished, successful individuals, it is their duty to give back, and charities love it when they do. I should mention that by making estate gifts to charity, the rich can take advantage of tax-favoring laws and loopholes in the tax code that allow them to reduce their tax liability by giving back to the nonprofit sector. Life insurance normally pays a tax-free death benefit when the person whose life is insured dies. The truth is, it's really death insurance, but nobody wants to hear that. Leaving money to charity after you die can be complex, and it often requires teamwork from professionals such as accountants, attorneys, and financial advisors. But insurance companies found ways around this, and recently some of them started offering riders or add-ons on very large policies for people who wanted to leave a portion of that amount to a charity. It eliminates the complexities I mentioned before. Number 2, leaving a legacy. Through my career, I've met my fair share of single-digit millionaires that, thanks to life insurance, were able to leave double-digit millions to their children and families. And I'm not about to release their names here, but I will say life insurance played a key component in most of those cases. Remember, with life insurance, you pay a small amount of money for a large lump sum death benefit when you die. So in a way, you can say you are slowly buying future tax-free dollars. Life insurance can get complex, but in its most basic form, it is designed for the primary purpose of leaving a legacy. The death benefit is the amount that gets paid to your beneficiary, which is the person, persons, or entity you designated to receive the money. Life insurance can help you set up a fund that your family can use as an income source for a very long time. Have you ever heard of the term trust fund, baby? Well, first, a trust fund is a legal entity that can hold any asset. To help you understand it a bit better, a trust would be the paper document that holds the instructions, and the fund part would be the actual money that gives the trust or paper a monetary value. It offers protection from probate as well as tax advantages. The baby part, well, that would be whomever is getting all that money. And also, depending on its design, it can provide wealth for many future generations, also known as dynastic wealth. Many trust funds were initially funded by life insurance. These days, it's a simple way for the wealthy to, well, stay wealthy. And if you don't believe me, remember back in 2014 when Radar Online put out a story on Kim Kardashian and Kanye West's prenup agreement? Whether it's true or not, you might have gotten caught up on the mansion, the $1 million per year of marriage that Kim gets, or the jewelry and gifts she'll get to keep in the event of a divorce. The most interesting part of the agreement, to me anyway, is a $20 million permanent life policy that's payable to her if Kanye dies. And the legal document states that it will remain payable to her even if they ever separate. Kim has already built her own wealth, but the marriage to the rapper ensures that she will not have to worry about going back to her humble beginnings. Thanks, Kanye. We're getting to the end here, but before I proceed with number 1, I wanted to let you know that I appreciate you watching and also that subscribing to my channel helps support me. So if you like this video, click on the subscribe button. I'm always putting new videos out. Also, leave me a comment and tell me which one of these 7 reasons you found most interesting. Or if you have a question, also put it in the comments section. I spend my mornings answering them. All right, let's get to it. Okay, so let's summarize what we have so far. At number 7, to protect collectibles. Number 6, kidnap, ransom, and extortion protection. Number 5, to protect against liability. Number 4, to replace income loss due to illness or injury. Number 3, for charitable giving. Number 2, to leave a legacy. The last 2 involved the use of life insurance as a tool, and this first one uses life insurance as well. Remember when I said earlier that rich people don't like paying taxes? It's why I picked tax strategizing as the number 1 reason why the rich buy insurance. Now, I'll give you another disclaimer. I'm not a CPA, and you should always consult your attorney and tax advisor regarding your particular situation, and these statements are for informational and educational purposes only. With that said, we already discussed that when someone dies, the death benefit payable from a life insurance policy is a tax-free benefit. But that's not the only way the rich use life insurance to avoid taxes. The truth is, tax laws favor insurance and allow for the wealthy to protect their assets. How do they do it? Ultra-wealthy business owners use life insurance as a way to pay for some corporate benefits to some key employees such as CEOs or high-level executives. The premiums can be tax-deductible to the corporation. Not to mention, some policies receive interest and dividends, and they are tax-deferred when they remain in the policy accumulating through the years, in a bucket called cash value, which is why most rich people don't buy term life insurance. Instead, they take out permanent life insurance such as whole life or universal life policies. You see, the wealthy measure value over cost. They know that they can access the cash value at any time if they wanted to, but also they can access those funds in the form of tax-free loans that can be used for pretty much whatever they want. Because you can plan ahead how much money you want to put into your life policy, many of my clients use life insurance to take advantage of this tax advantageous growth throughout their working years. It helps balance other taxable savings plans they may have in place. Also, business owners will use these policies to fund buy-sell agreements so that if one of the partners suddenly died, the other partners can purchase the deceased shares in the business with the tax-free death benefit, without having to use up cash from the business to buy out the surviving family. Most importantly, when you're ultra wealthy, your main tax liability concern is probably the death tax, or more formally known as the estate tax. If you've never heard about this, well, estate tax is a tax liability that applies to individuals with estates worth more than $11.4 million, or for couples with estates worth more than $22.8 million combined. That's as of 2019. The threshold limit changes all the time, and the estate tax is applied on the monies above those limits. There's a lot of information online, and because this video is not a lesson on how estate tax works, what I want you to understand is that wealthy, savvy folks will buy life insurance to use the proceeds to cover the tax liability that would be owed by their estate if they passed away. And there you have it. 7 reasons why the ultra wealthy believe in coughing up a premium payment for insurance. And the thing is, if the wealthy believe that insurance helps them build, grow, and preserve wealth, don't you think you ought to take advantage of that? Think about that. Thanks for watching.